It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
On this day, back in 1979, Margaret Thatcher becomes Britain's first female Prime Minister. Now, how would she go against Donald Trump? She would not take a step backwards, I would suggest. That would be worth an admission fee for sure. Let's take you to Auckland right now and catch up with Sharon Zollner. She is the chief economist at the ANZ Bank of New Zealand. I note that you grew up on a farm near Methven in the South Island, and the reason that I say that is that I've done plenty of skiing on Mount Hutt, which is a fantastic mountain for skiing, of course.
Thanks for the plug. Yeah, the outlook for our tourism industry is a little shaky at the moment, so the more Australians that come skiing, the better. Our exchange rate's certainly working in your favour. You'll feel nice and rich when you come here. Spend lots of money. Sounds good.
Let's talk about the business confidence slump somewhat in New Zealand. Now, you've noted that while business confidence fell off a cliff last month, the initial shock, partly driven by the global cost pressures, may be dissipating. Tell us about that.
In the data in March, we did take a look at how it evolved over the month, and the April data was slightly better than the March month ended. But yeah, maybe that's clutching at straws. It's been a very sharp fall, understandably. Firms are expecting their costs to take off, and they're not expecting to be able to recoup that in their prices. So it's quite a profitability shock, and a lot of firms are also worried about what might happen to demand for their products. Some of them are worried about inputs with supply disruptions to all sorts of things well beyond just fuel.
That sort of brings me on to the consumer pessimism. Is this true? Consumer confidence plummeted to levels not seen since the global financial crisis. Is that right?
No, not quite. It's plummeted to levels that we saw during the inflation surge in COVID. Some of the questions did fall to the lowest since 2008. In particular, the question about perceptions of current personal financial situation. So are you better or worse off than last year? A net 31% of people, so just about a net third, said they're worse off. And that is the weakest since mid-2008. And that will definitely be related to the cost of living pressures that people are seeing because of, well, not only petrol actually, though that's been the dramatic change, but food price inflation has been very strong as well. Also, our electricity inflation's been running in double digits. And these are all necessities. And so understandably, people are not happy.
Yeah, so let's have a look at the borrowing behaviour, especially around real estate. Borrowing capacity is still very much constrained, keeping buyer activity measured. What is happening from your guys' reporting around the New Zealand real estate sector at the moment?
The credit side's interesting because the market's still very competitive. Banks are competing on price and on terms, so credit conditions haven't tightened meaningfully. There was a report out by Centrix late last week saying that actually things were picking up. It really reflects the world before this oil price shock happened, but there were clear signs of mortgage demand lifting and the housing market lifting. And you sort of talked about New Zealand as a whole, but parts of New Zealand, the housing market actually looks more like Australia, and that is the South Island, which has got ski fields. That's part of it, is tourism, but also a very strong agriculture backbone. And the prices for dairy and meat have been excellent the last few years. So essentially, New Zealand has split into two teams, and the South Island economy has been doing much better, whether you look at house prices or jobs or credit arrears or whatever it might be. Whereas Auckland and Wellington have been having a tougher time. But actually, in February and March, things were looking up. If you look at a chart of house prices, it looks like the bottom was in and we were starting to lift a little bit more than we were expecting even. But now with consumer confidence having tanked, the market has moved to price more hikes this year, and that has had such an impact on the wholesale interest rates that it's actually driven increases in mortgage rates already before the RBNZ even does anything.
Good morning to you, James. It has been a while since we last spoke to you on the Real Estate Breakfast. How have you been finding your local market there, especially in the last couple of months?
Yeah, thanks, Craig. Yeah, the market has been interesting. Obviously, there's been a lot going on globally with the economy, with inflation. Interest rates seem to be rising. Probably will go up again today. In terms of the market, look, it has been challenging. It did take some time for alignment to happen, where we're seeing, owners come to the table and meet the market expectations. I guess what we're feeling, and I kind of feel like this is very similar to the walk into COVID market, where there was a lot of uncertainty. We didn't know what was happening. Things really shut down, but there was always demand. Well, in our markets anyway, there's a supply issue. The buyer demand is there. It's just a confidence piece now.
Because you're in the Eastern Beaches, of course, a lovely spot to be in Sydney, but you're in that upper median price point. So when it comes to the RBA, you've got some built-in insurance, haven't you? Just in terms of some people not requiring a mortgage, and that makes it a lot easier to transact with people.
Yes, that's right. That's right. We are lucky to have that as part of our marketplace. Like I said before, the supply, there's not a lot of properties being built or released in and around our marketplace. So the demand is always there. We're lucky to be close to the water and people want to live near the beaches. So that really underpins our market. And again, I feel for us at least, it's more a timing thing where, like I said before, the market just needs to settle, find its feet. Properties do trade, death, divorce, upsizing, downsizing, financial pressure. People do need to move. If you're buying and selling the same sort of market, it doesn't really matter what's happening, because if you're selling for a little bit less, you'll be buying for a little bit less, and vice versa.
We should talk about the vendor expectations, because it seems finally they're being met, or the vendors are adjusting on their price. Becoming more realistic is what it's all about when it comes to pricing, which is at the end of the day helping those deals get done. The gap between buyer and vendor expectations, it has narrowed in Sydney, but not completely closed, I'd suggest. Some agents report that well-priced properties still attract competition, while those overpriced listings, they still struggle to gain traction at the auction. I guess that is really frustrating, right? From your point of view, you're an auctioneer, you're on the ground, you're having these expectations not quite align with the market, and sometimes you can go through that process where it does take an auction before the vendor suddenly sees the light.
Yeah, that's right. It's a process. And, in terms of expectations, good market, bad market, what an owner wants, what an agent thinks a property's worth is quite irrelevant. It's what somebody's prepared to pay for it. So, running the auction process allows us to, filter through the buyers. We can ascertain value through their offers and then put those in front of the owners to say, this is where the market's at. Unfortunately, a lot of the time now it's below the expectations. But again, it comes down to their motivation. If it's a property that they need to trade, then this is the market today. We're not certain what's happening in the next 12 to 24 months. We don't have that crystal ball, unfortunately. But the auction process, it's clear, it's transparent, and it gives an owner a snapshot of this is exactly where the market's at. You're having the best, most active buyers in the market through your property, and this is where they're seeing value. And essentially, that's what properties are worth.
More properties are passing in at auction and selling shortly after through negotiations. Now, that is indicating to me that buyers are holding back during bidding, but still wanting to transact at the right price point.
Yeah, it's quite commonplace, and sometimes you do need to run the process. So it will open the door for a vendor to see where the buyers are at, and then also the buyers as well to see, who am I competing against? Sometimes they need to have the certainty of an asking price or a counter offer, which will often come after the auction, where an owner says, well, okay, we've reached 2.5 million, we're at 2.8 million, and we can meet somewhere in the middle.
So overnight, Anthony, mortgage holders across Australia, they brought out the calculators, they were doing their numbers and realising more of that pain to come.
Obviously, mortgage holders are adjusting. I think most mortgage holders had already accepted that was probably the likely outcome, and it's now been implemented.
Yeah, we were talking about this last week, and some banks are sort of saying, well, there may be some relief towards the end of the year. I said last week, I can't see a rate cut this year. Might be proven wrong on that, but I would expect see another rate increase or two.
Well, yeah, look, on the back of last week's inflationary data, on the back of what we're seeing, I think we are looking at least one more rate rise, maybe two. Some of the banks are talking about that. It's going to depend on some factors out of our control, geopolitically, and it's also going to depend on government reining in their expenditure and domestically bringing inflation back into line. It could be another one or two this calendar year, absolutely.
We've been on this roller coaster since COVID, really. To go back to pre-COVID conditions, a different moment in time, a different borrowing rate. And as the lyrics go in that Beatles song, yesterday, all my troubles seem so far away. Ain't that the truth? But that's now a distant memory, unfortunately. Let's take you to Perth right now. Catch up with somebody we haven't spoken to in a while, and that is Matthew Hughes, the Managing Director of Capital Property Advisory. We need to ask you how the Perth property market is going, because it does remain one of Australia's top performing property markets, with annual growth still outperforming capital cities.
Good to be back with you, Craig. And yeah, the Perth market's still very robust. I think nationally there's been a little bit of steam come out of all markets, but Perth's pretty well protected given the structural undersupply issues that we have here. So it's still very competitive, but it is sort of morphing into a more of a two-speed market. You've still got the bottom end performing very well, the middle almost keeping track, and the upper end is still competitive, but not performing quite as good from a growth perspective. Still difficult buying out there, but there has been a little bit more stock come to market just recently throughout the start of this year, which is helpful for us as buyers agents.
Yeah, the national median house prices are mentioned, 910,000. Perth median price, 1,025,000 these days. Perth's annual growth, 194,000 in the housing market. That is up 21.5%. That is very strong, isn't it? Whichever way you cut it.
Yeah, and it was trending even faster in terms of the rate of growth over the first quarter of this year. I think it was 7.6% over the quarter. That's equating to about 30% per annum. I don't think it'll keep running at that rate, but that's what we've seen to open up over in Perth this year.
What did you make of that? 25 basis points with more to come.
Yeah, I agree with the more to come statement. I think there's at least one more lever that's going to be pulled this year, maybe two. And look, you spoke about Perth's housing price having hit $1 million now. Strangely, it's still relatively affordable compared with other capital cities based on the higher incomes over in WA. It certainly has people sitting on their hands a little bit. We've noticed just a little bit of a slowdown in terms of new inquiry from clients. Unfortunately, this is the best time to buy, so we're encouraging our clients to tap into the equity that we've helped them create and get out there while other buyers are sitting back, because it is that little bit less competitive. But unfortunately, not everyone's got the confidence to do that at the moment with everything that's happening locally and globally.
Yeah, indeed. Now, more properties, as you say, they're coming to market, particularly in Sydney and Melbourne, giving buyers more choice. It is nice for buyers to be in that position. And there is this small uptick in Perth. I note, well, firstly, I'll get you to talk about that, because I want you off the back of that to also talk about the fact that you are mainly buying in Melbourne and Geelong.
We are, yeah. There's a handful of middle ring suburbs that we're hitting pretty hard at the moment in Melbourne, and I'm very bullish on Geelong as well, especially for clients that are a little bit more yield sensitive. I think that that's where the best capital growth outcomes will be over the next 3, 4, 5 years. Despite the fact that Perth's obviously going to outperform Victoria this year, I think the ledger will start to balance moving into 2027 and beyond.
We have the return of mortgage stress as saving buffers disappear. And I know that this is a space that you guys like to cover at Finder.
What we know at the moment, we have this Finder's cost of living pressure gauge. And at the moment, it's sitting at 76%, which is in the extreme pressure range. So we know Australians are under a lot of pressure. And it's been there, it's been quite high since January. And of course, since January, we've had 3 interest rate rises. So this is the most stressed that people have been about their finances in quite a while. And 54% of mortgage holders specifically say they are experiencing increasing mortgage stress. So that's quite a significant amount. Over half of people with a mortgage are under stress financially. It does not feel like the ideal time for another interest rate increase to be flowing through, but it is the situation we find ourselves in. So it's something that we need to figure out how to avoid getting into actual arrears and financial distress while we're managing these increases.
This weekend, can you imagine everybody that has got a mortgage that has some sort of pain, and I would say it's right across the board. They're going to be sitting down. They were doing it on Tuesday when the announcement was made, but this weekend brings everybody together. How do we save more money on money that we've already saved? So that second phase of pressure is really biting, isn't it?
Absolutely. And I think you raised such a good point there that, sitting down and looking at the information and the data is the best thing you can do, because it's obviously stressful to get an increase to your mortgage interest rate, but it might not be as stressful as you think. And what I mean by that is I have a big mortgage on my house. When I got the news, what I thought in my head that my increase was going to be was actually a lot higher than what the increase was. So I think the first thing anyone should be doing is looking at your actual situation, seeing what that increase is, so that you're not worrying about what it might be, you're worrying about what it actually is. And once you know what it is, that's really good data to work with. And say you've sat down and looked at your mortgage and realized that your payment is going up $150 a month, which is a very stressful amount over 12 months. That's $1,800. Well, then your next step is to look at, how do I replace that somewhere else? How do I save money somewhere else to cancel out this increase? And for some Australians, that will be as easy as calling your bank, because some banks at the moment are offering discounts of up to 0.2% or 20 basis points, which almost wipes out this increase. Some of them are offering cashbacks if you stay with them, and other banks are offering cashbacks if you refinance to them. It's really the best time to be shopping around and looking at what you're paying, seeing what offers are out there to see if you can claw this money back some other way.
Yeah, I'm a big fan of refinancing. So many people still don't do it, and you've got to do it. You've got to save on the money, because we are being belted around at the moment when it comes to all the expenses going out of that household. As I mentioned, people will be this weekend sitting down talking about their finances. There will be some, unfortunately, that will say, we've got to sell our property. We cannot hold on any longer. Renting versus owning has become this big debate. The widening gap between mortgage repayments and rents, particularly in cities like Sydney, they are there to see. And are we seeing a psychological shift where younger Australians are becoming more accepting of long-term renting? It's that mindset that is baked into the brain.
Oh, absolutely. I think buying property in Australia is culturally, it's a rite of passage, and it's almost an expectation that you're going to be a homeowner. And that is quite unique to Australia. In other countries, it's not quite as assumed. In many European countries, home ownership is not something that is expected of young people. I'm not saying that to say that we should adjust our expectations. I think it's very normal and a great, goal to have, to want to buy property. But I do think that it's shifting in Australia in a way that we've never seen it shift before, because the difference between what we earn and what properties cost at the moment has just grown so wide. And I don't know what it would take to be able to bring that gap, close that gap a little bit, to make it more affordable and achievable for young Australians. I do remember, this feels like a new issue, but it has been bubbling for a long time. And I do remember probably 15 years ago, it was around 2010, it was after the GFC, and I remember reading some research and some modelling that said Sydney in particular was on track to become a city like New York City that would have a majority of renters and a minority of owners, simply because it's such a landlocked city. There's nowhere to grow except for west, and people traditionally, they want to live closer to the ocean in Australia. So when you look at those fundamentals, you have to build up. Looking ahead, they said, I think we're going to end up more like New York than we ever have before.
We connect you to the best real estate information across Australia. The Real Estate Podcast.